Hello, and welcome to this special weekday Motor Trade Radio podcast, powered by Motors and Cazoo, with Philip Nothard and Curtis Hutchinson, bringing you all the chatter that matters.
Hello and welcome to Motor Trade Radio. Today we're delighted to welcome back friend of the pod, Steve Young, Managing Director of ICDP, the International Automotive Retailing Consultancy. Regular listeners will know that Steve is also the Managing Director of Auto West London, the Omoda and Jaecoo business, which opened in March 2025 and marked the UK debut of Çağdaş Automotive, Turkey's biggest dealer group. So in the first half of this show, we'll get Steve's take on some automotive news stories making the headlines. Then, after the break, we'll get an update from him on Auto West London's operations. So welcome back to the pod, Steve. Great to have you back on. As ever, there's plenty to chat about, isn't there?
Yeah, there's no shortage of fun in the automotive world at the moment, that's for sure.
Just general, yeah. Every day keeps us all busy, keeps us all on our toes, doesn't it, Steve, to be fair?
It does, but we wouldn't want it to be boring, would we?
We won't.
Definitely not, no.
Yeah, I mean, obviously, welcome back, and it feels that we don't want to wish away the year too soon, but we're getting towards the end of January very, very quickly, and Christmas and New Year seems a long, distant memory, as does 2025. So let's get going a little bit, and let's start off with the ZEV Mandate, and just this week, the FT ran a news story on the report by the Policy Commission on gigafactories, which is an independent of the government, suggesting that the UK should relax its targets to phase out ICE vehicles from 80% in 2030 to 50 to 60% and reduce OEM non-compliance penalties. Now, the Commission also suggests that this will better support domestic battery production by attracting investment in gigafactories. And as an industry analyst, I mean, what's your take on the best way forward for the ZEV mandate for both probably the OEM perspective, which I know you've got a very, very close eye on, and obviously for dealers as well?
I think that the suggestion that was reported that if you basically take some of the pain away of the ZEV mandate, that the money will automatically flow into developing gigafactories is sort of naive. They're looking at it through a very, very tightly focused lens, and I think the reality is that if the ZEV mandate was phased out and that pressure, or reduced, relaxed, and the pressure was taken off the manufacturers in that area and the related costs, then they would either breathe a sigh of relief and actually start returning sort of decent margins to shareholders again, or find many, many other ways, including, for example, fighting against the electric cars.
Yeah.
Whether it should be relaxed or not, then absolutely yes. Not because it's going to put the money into the gigafactories, but just because we are totally out of line with everybody now in the UK. China doesn't have a 0% target. The States doesn't, and going even further away from it. So we're the only country now which has this 0% target, and that has to be looked at hard. I'm not saying abandon all green objectives. I'm just saying that the policy is out of line, and that's going to create distortions, and does create distortions.
It does feel that it's creating the wrong behaviour, financial cost to everybody involved.
It is. I mean, I think we won't go back into Dieselgate and all the other reasons why the industry lost its influence with the regulators, but at the moment the manufacturers are incurring massive costs, and the dealers, some cost, and certainly inconvenience and stress and complexity in order to massage the numbers towards the targets. I find it remarkable that some of the people who are involved on the government side and external commentators from the green side of the debate, then say, "Oh, look, success. We've achieved a target, or we got close to achieving the target," and completely ignore the fact that if you're faced with a £15,000 fine or a £12,500 fine or whatever, then you're going to find a way to make the target. But it doesn't mean it's natural. It doesn't mean it's real demand, and it doesn't mean it's a good idea.
And Steve, following on from that and sort of continuing this theme about EVs and demand, earlier this week, the Times reported that Stellantis' European boss, Emmanuel Capilano, said there is currently no natural demand for electric vehicles in Europe. And he actually went on to clarify that by saying demand only arises when there are subsidies in various countries or when car manufacturers reduce prices by burning cash. So a pretty damning view there from him. How would you assess natural demand for EVs in Europe and the UK? And do you expect it to shrink or grow this year?
I think that I had the privilege of being invited to the Stellantis dealer conference, investor conference, last week, and they're talking. They've got a good story to tell. In terms of what they're trying to do to strengthen the various brands, but particularly around electric vehicles, electric cars, and they. In a general theme across the sessions I went to was that they were offering price parity or close to price parity on BEV and ICE. So it takes that element out of the discussion, and it means that it's a very straightforward, simple offer without saying, "Oh, well, we'll subsidize it, we'll discount it, there's a special promotion this month," and so on. But we don't know what's going on in the background in terms of the burning cash comment. We don't know how much it's costing Stellantis to do that. They've got a strategy which seems to allow them to flex the production, which is a good thing, rather than having the dedicated BEV platforms and production lines and supply chains and so on. Undoubtedly, they're making less margin on BEVs, and maybe they're genuinely subsidizing them. I think probably it's just a lower margin than they would like and they ultimately need. But I think there is natural demand. There's lots of surveys around, including our own, which show that once people have an pure electric car, then they tend to repurchase pure electric. They like the experience, they enjoy it, they understand the reality of owning one, as opposed to some of the tabloid press, hype about, battery fires and lack of charging infrastructure and so on. And if you're in the right place and have you the right driving pattern, the right usage pattern, then an electric car is great. And I think the natural demand is there and it will grow, but it is at this stage a lower margin than the ICE products, I'm sure, because different stages in technology curve.
And with all these headwinds, what's your view on when that natural demand will actually grow? What sort of time frame do you think?
I think that if you were looking at, I think going back to that FT report, then they were talking about perhaps a good objective for a ZEV mandate would be 50-60% in 2030, not 80. I could see natural demand for new cars being 50, for new BEVs being at 50% by 2030. It's 4 years from now. It's another, 2 ownership changes, potentially 2 ownership cycles on from today. So some people might be on their 3rd, 4th electric car by then, and word of mouth and experience and so on helps. We're also much further down the technology curve. You see what's happened with things like solar panels and so on, and how you get to the point where the price collapses. And I think that we may well be in the point where you can still make a normal margin on a BEV by 2030, so that everyone can be happy. But for some people, they'll still want their petrol car, their combustion car, because they live in mid Wales, or up near Phillip in the wilds of the Yorkshire Dales.
Yeah. We won't mention the story we covered last week's podcast on Saturday about the report about the end of diesel at the pumps.
Yeah, I heard.
Being fairly imminent, which, I think that's kind of totally ignoring the vehicle park as it is at the minute, and the rest of the sectors such as the LCV, heavy goods, etc. in the marketplace. But I mean, we can't have you on without talking about your view from probably the ICDP element, but on the dealer sector, particularly on the UK dealer sector. I mean, we kind of just over 2 weeks into the new year, we started to see a few regional acquisitions. Thurlow, Nunn acquiring Spirit Motors Group sites in Corby and Northampton. At the same time, you've got Graingers Motor Group acquiring Norton Way, Honda, Nissan and Mazda sites in Letchworth. I mean, what does this tell us about the likely appetite for growth and exits this year? And do you see more of these small to medium-sized regional acquisitions happening throughout 2026, get the year right?
I think so. I think obviously that you've got two sides. You've got the buyer and the seller, and if you've got sort of Spirit and Marubeni who decided that they want to reduce their exposure or eliminate their exposure to the automotive sector, you can understand why. All the reasons that we've been talking about earlier, that you talk about in the pod every week. It's a difficult, tough market out there, and if you don't think you're going to stay the distance, then if someone's coming along with a decent offer, then clearly you're going to take it. Why would you continue to stomach losses, take risks, put more capital in, more stress with trying to get the right people to work in a more demanding, more technical, more digitally based environment, if someone's prepared to take all those problems away from you and put some money in the bank for you to go and invest in other sectors. So very easy to understand why people would want to sell. And then, if you look at Thurlow Nunn, then, really strong regional group. Sort of I live on the fringes of their sort of area of interest, and it's good that they're continuing to expand, and there are clearly benefits in scale. So particularly if you keep it tight, if you keep it tightly clustered. Graingers, slightly different situation. Coming home, they know the business. The individuals know the business as well. But then that also means that they should have some high confidence that they're coming in with ideas about what they can do to improve them and to take them up to the next level. And that's just repeated all over the country. I think there are lots of investors looking to quit, but there are still lots of people who, are looking to succeeding with their existing businesses and want to expand that. Because in the end of the day, franchise motor business, the only way really you make more money, pound note terms, is by having more businesses. You can't generally sustain a 5% margin or something in a franchise business. In the UK, that's a very, very exceptional situation.
And I mean, what's from the larger groups and some of those more internationally owned groups or domestically owned large, the top end AM sort of AM 10, AM 20s territory. What's the view at the minute? I mean, we're seeing seems to be still a bit of an appetite for acquisition and growth, but there's also a little bit of consolidation and restructuring taking place with those larger groups. What's your view this year on some of those operations?
I think that with some of the larger groups, if you look at what's been happening with people like Lucas in Group One, being some of those larger groups who have been selling or announcing the sale of outlets, then I think that you've got sort of a recent change of ownership or change of management, and they're just putting fresh eyes across the business, and maybe taking both of those as examples, led by, without any disrespect, finance guys rather than car guys. So maybe they're looking at it more objectively, less emotionally. They're not going to sustain businesses because they like the brand or like the product. They're going to do it if they can see that there's a way to a solid return in the future. And so it's a bit of portfolio management, but through objective eyes, head over heart, if you like.
Yeah, and like you say, there's some big costs that have come in last year and again this year, isn't there? That's trying to manage, some of those heavy costs. And we talked, I think, last Saturday about the rates reversal from the COVID reduction or freeze on business rates that will be hitting as well this year. So there's some big costs coming in some of these larger groups, isn't there, in addition to others. So it's going to be interesting this year.
Yeah, and some of the individual sites that are coming up are monster sites, with very high costs. And if you can't see yourself through to the point where you're going to be running a correspondingly very high volume, then it's never going to work. It's not viable.
We'll be back with more from Steve after this brief break.
You're listening to all the chatter that matters on this special weekday episode of Motor Trade Radio, powered by Motors and Cazoo.
Now, Steve, as we said at the beginning, we couldn't have you on without talking about your other job as MD of Auto West London, the Omoda and Jaecoo business in Chiswick. Now, looking at last year and bearing in mind you opened the business in March, collectively over the course of last year, the Omoda, Jaecoo and Cherry brands accounted for 2.5% of new car registrations in the UK. That was equal to BYD, but actually ahead of the likes of more established brands such as Honda, Mazda, Seat, and Dacia. So I'm curious to know that, was this level of demand in line with what you actually saw on the ground in your business?
Yeah, I mean, it was crazy. We've got a great team, but we're, to be perfectly honest, we're much more order takers than we are sellers, because people are coming in, they've done their research, there's a lot of noise, a lot of publicity around the product, and people come in wanting to buy. And it's that's a great situation to be in for anyone, but a particularly great situation to be in when you're just opening up, and you need to establish scale, and you need to establish a reputation. The more people you can get out there, who are giving you great reviews and referrals and so on, the better. So we've got absolutely no regrets about going with the Omoda Jaecoo. When we did, I think the launch would have been much more challenging with a brand which didn't have that sort of story, running on in the background.
Yeah. And as a business, you're obviously now seeing a greater number of trade-ins. So are there any trends you're spotting in terms of which brands are customers coming from to go into Omoda and Jaecoo?
Predominantly premium brands. So we're seeing Mercedes, BMW, a couple of Volvos, a couple of Land Rover Discoveries, or Discovery Sports actually. Lexus, I don't think we've had any Fords. don't think we had any Vauxhalls. We had a couple of Peugeots. So it's probably 60%. Premium or top end volume. Volkswagen, for example, and that is how they positioned the brands, haven't they? I mean, they've said you're getting buy the product and we'll give you the badge.
And that's interesting in itself, isn't it? Because many of those brands that you've mentioned have traditionally enjoyed fairly strong brand loyalty, but it seems now that customers are really weighing up. Do they want maximum value for their next car purchase, or do they want the badge? And they're probably going with the former rather than the latter.
Well, I think the argument's really compelling. I mean, most of my sales team have come from premium backgrounds. We've hired in from BMW dealers, Mercedes dealers, and so on. And one of them, just out of curiosity, ran actually our sales director ran a comparison for an M120, BMW against an Omoda 09. Now, Omoda 09 is bigger, but it's 440 horsepower. It's plug-in hybrid, 90 miles of battery range. It's a truly brilliant specification. And a 120 M120 BMW was the same monthly payments and the same deposit, and so when you're in that situation, you've really got to be truly brand dedicated to say, oh, I don't mind throwing an extra couple £100 to get like for like. We keep on getting customers coming in and GL Mercedes and the big X6 BMs and things like that, and they're coming in to buy an Omoda Jaecoo, because they're saying this is mad.
And we've talked about Omoda and Jaecoo. There's also Chery, which is the sister or indeed parent brand back in China. Are there any plans for you to add Chery to the portfolio? And if so, when's that likely to be?
We're looking at a number of different options. We would like to expand with Chery the group, so Omoda Jaecoo, the Chery brand, got other brands coming. We'd like to add other new entrant brands. We'd like to add other established brands. If we're looking to have, within our relatively tight geographical focus, 3 or 4 dealerships for 3 or 4 brands in a few years' time, then 2026 is when we need to get started on that. So we're in active discussions, with all of those potential opportunities, and it's just a question of trying to find the right fit, and at this stage also to manage the risk, because we're still, although we had a great first year, then we need to be cautious, because we can't carry a loss-making business for a couple of years at this stage of our growth. It's different if you've got 50 dealerships. Maybe you say that's okay, I can do that. We need to get brands and locations where we can be up and running relatively quickly, either at least break even, hopefully a modest profit, at worst a modest loss. But we're not going to sink hundreds of thousands and millions into opening up a new point with a new brand. So that's the stage that we're at the moment. So Chery's in the mix, but not only Chery.
And I mean, thinking of used, and particularly Omoda and Jaecoo, and just this month that they've launched the OJ approved used car program, and it's described as a comprehensive package including manufacturer back warranties, quality checks, finance offers, 12-month roadside assistance, and that's renewable upon servicing in the network. And suggesting that the Chinese owners acknowledge obviously the importance of the used car market, which was sometimes in doubt initially when the Chinese started to enter the UK market. And this is really, how is this doing for the dealers, and how important is this in terms of the initiative to the network and you in particular as a business, Steve?
The used car business clearly, is important, and with Omoda and Jaecoo, and for that matter, some of the other brands, BYD or MG, or then they've got quite a broad product range. You need the demonstrators, you need the courtesy cars. You're growing your staff headcount quite quickly, so you are generating a decent number of used cars, and we found that relatively easy to move those cars on, still with a good margin. So I think I'm on my third Omoda 09, because of the miles that I do. So, but we've had no issue finding customers who are prepared to buy those, and we still have a good margin left with 5,000, 6,000 miles on the clock. The approved used, makes sense. It gives you a sort of an additional endorsement, if you like. The requirements from Omoda and Jaecoo are not too onerous. That's not true of all used car programs. In some cases, they add cost and not value to the dealer. But it opens up another channel for us. And I think that the better Chinese brands have done a good job of thinking about residual values from the beginning and taking advice from people who really understand the UK industry and the UK remarketing and so on. And if you don't do that, you're not going to have competitive finance offers. You look at the mess that Tesla got into because they just focused on new car sales and ignored the consequences of that on residual values and ultimately on their attractiveness of the brand, because you can't support the lease price without or the PCP price without a strong residual.
Yeah, I couldn't agree more. And I mean, you touched on it a little bit earlier with Curtis saying obviously about those used cars coming in. I mean, 10 months in, how is your used operation now starting to develop? I know last time when we caught up last year that that capacity of space and that used operation alongside your new, how's that starting to develop?
Being brutally honest, it's ticking along. It's ticking along. When we've done the budget for this year, because of the space constraints that we have, then we actually worked out that we're better off putting another franchise into the second site at Wandsworth and restricting used cars rather than turning it over to used cars, because the margin you can get on the new entrant brands is better than you're going to get or at least that we've been getting on the used cars. So we'll get a better return on the site. We'll get a better return on the team, and because in general, from what I can see across the industry, trade-in volumes are lower than they used to be because of We Buy Any Car and Motorway and all these people. Then it just means that we won't go out into the market to buy more used cars, or to the extent we do, it will be relatively modest. And we'll just focus on trading the good quality trade-ins that we do get. And that gives us a better mix. But I think that's one of the issues about operating, within London is that you don't have the space, and people are going on Auto Trader and they're looking at car first and location second. So why would they come into London to buy a used car with all the costs that we have associated with operating in London, when they can go, not very many miles out to Slough or wherever, and where the space is more plentiful and cheaper. So it's something that we want to do, but we'll do it because it's going to make us more money than the alternatives, not because we want to tick a box and say, look at how big a used car business we've got.
And finally, Steve, as a retailer, how has the new car market performed so far in January? And how are you preparing the business for the March plate change? Because you'll get a decent run at the March plate change this month, won't you?
We will, and the conversation that we've had with Omoda and Jaecoo is basically, guarantee us you can supply us the stock, and we'll go flat out from day one. The demand is there. What I obviously don't want to end up doing is pushing the sales through January, February, and then creating a hole in the supply situation for March. So I'm assured that the stock will be there. So we've got pedal to the metal, and we're going to just go gangbusters and see how it shapes up. And if it goes well in the first quarter, then we'll just try and keep that momentum up through the rest of the year. So this is for us. Last year was building year with all sorts of growing pains associated with it. This year is the one to see what we can actually do with the constraints that we have around the site and so on.
Yeah, you say this is your full year, isn't it? I suppose now starting that you've got your full budget in place and full operational year ahead of you, haven't you? I suppose.
Yeah, and there's still wrinkles. There's still things that we ultimately need to address. Where we've issues with stock funding, because we're still a new business. We're not 3 years old. We're 1 year old, and so those sorts of constraints or those sorts of issues still exist. But in the course of the last few months, we found solutions to those. We're working around them, and so there's no reason why we can't just try to max out and see what we can do. But operating in London, it's a different ball game to a situation where you've got huge sites and much easier logistics than we have.
Yeah. I mean, in some ways, you've got some nice problems to have, but obviously the constraints elsewhere. I mean, huge thank you for say the start of a new year and sort of catching up and setting the scene a little bit, obviously from yourself in terms of the market with your ICDP and obviously from the front end operational side at the dealership there. And obviously I know that you're busy else doing your ICDP element, because you've got your next sort of first sort of in-person members meeting coming up on the 17th and 18th of March over there in Amsterdam. I'm hoping to get there myself. But can you share details of what people can expect, those that are attending or those that may wish still to get involved and attend if they're not already doing so?
The March meeting is sort of the end of our program year, so we wrap up on a number of different topics. So we'll be talking about new entrants. We'll be talking about BEVs. We're going to be looking at after sales and the cost of living pressures and how that's going to influence the decisions that people make about repair. We've got another look at the impact of electrification on workshop capacity, workshop demand, and so on. So there's a range of the other topics. And then we've got a guest speaker slot, which I think is going to be really interesting, which again is picking up on the impact of new entrants, but slightly different perspectives. So we have the Lawrence Hamilton, who's the CEO of Lucid Europe, who are coming here maybe in a year or something like that, formerly with Genesis, and a guy called Jörg Heinemann, who was previously responsible for the project team rolling out agency for Mercedes across Europe, and then became head of Germany. So he's just stepped down. So he represents one of the oldest brands in the market. Lawrence represents one of the youngest brands in the market. So we're hoping to have an interesting discussion about the changing of the guard, if you like. So are they shuffling along, or are they going to replace them? So that's going to be good. And I think we're always happy to have, although the meetings are closed to members, if somebody's seriously interested in joining the research program, then we're always happy to have them come along as a try before you buy basis. So they can email me, steveyoung@icdp.net, and we can have a chat. They may even find they are members without realising it.
Yes. Yeah.
Well, that's all for now. Many thanks once again to Steve for joining us and sharing some of his thoughts as both an industry analyst and retailer. And many thanks to you for listening to this special weekday Motor Trade Radio podcast. We're back with the headlines this weekend. Until then, it's goodbye from me.
And it's goodbye from him.
Thank you for listening to this special weekday Motor Trade Radio podcast, powered by Motors and Cazoo. Philip and Curtis will be back with the week's big motor retailing headlines on Saturday.